Yes, so the other event, which I'm much more focused on, is just this change in expectations of rate cuts. And we have gone through a series of dashed expectations from the beginning of the year when the markets were expecting 6 rate cuts. Now remember, the Fed had only projected 3 rate cuts in 2024, but the market got very bulled up, expecting 6 rate cuts. In March, toward the end of March, the inflation data was not as cooperative as the market wanted or the Fed wanted, and so those rate cut expectations were pulled back to 3 rate cuts. The market really took that rather well, so we were back in line with the Fed's projections, and now more recently, since we got this higher than expected inflation data in the CPI and core CPI, now the market and the Fed are confirming that rate cuts may take longer. And that has been more problematic for the markets. So we've essentially gone from 6 rate cuts to almost 0 rate cuts in 2024. Once again, I think that this is a matter of the market digesting this information. And yes, it'll be convulsed for a period of time, but the market will absorb it because the macro backdrop in terms of fundamentals, in terms of consumer strength, in terms of corporate profits, et cetera, is really positive. So I think from an investment perspective, you really have to look at what is driving this inflation. The driver is good growth, and good growth really drives earnings and ultimately drives returns. So if anything, amid this market volatility, we are adding risk. The rates market has been very interesting. Again, it's all around how much and when the Fed is going to start their cutting cycle. We're at 5.5% Fed funds rates, and the market is incredibly anticipatory as far as when is the Fed going to pivot. And they thought they were pivoting at the end of the year of 2023. And that's when the expectations for 6 rate cuts really was driving equities, driving risk appetite, et cetera. So we're pulling that back. The inflation data surprised to the upside in January and February, and it seemed like March CPI and core CPI was the clincher. It was finally markets engaged with, maybe the soft landing story isn't as soft as we thought it would be. So I think that's what's gotten markets more volatile and more uncertain in terms of the rate path. But I think that the market can handle higher rates for longer. Firms have pricing power, their earnings have been extraordinary, and an environment in which the Fed stays on hold and at least doesn't tighten. If we can see the path toward rate cuts eventually, that should be a good environment for business, even consumers. The banks just reported on their credit cards and consumer loans, et cetera, and the consumer is still strong. Remember, we are getting real wage gains recently, and that's helping the consumer. So all the fear-mongering around the consumer collapsing, I think are overblown. So generally, yes, we're seeing volatility, but I am really viewing that as an opportunity to actually put on risk at somewhat cheaper levels.